Welcome to the B.F. Anderson Technical Report for February 24th. This is straight off the AAII webpage. I think it's an interesting thing to keep tracks of. Now, realize this survey, or AAII, has over 2 million members, so it's a very broad survey. And, Gerald Loeb in his book, Battle for Investment Survival, said that, the masses are always wrong. Well, it has to do with when everybody runs to one side of the boat, that kind of concept. Well, as you look at the latest survey of last Thursday, now they'll update again on Thursday this week, but the reading was 19.2% bulls. Now, what's interesting about that is it's very rare that we see that. Most of the time it's above 20%, but this is really kind of historic levels. I mean, you can look at the historic average is 38% bulls, but very rarely do we get below 20%. So the thing to understand about sentiment, it is a secondary indicator. It is not a primary indicator, but it is something that is very important to understand because it means everybody's run to the one side of the boat, which means we're getting incredibly negative here, which means a lot of cash on the sidelines. So if we go back through history and kind of understand how many times we have seen this. So there's been 31 weeks out of the history of the survey where there were less than 20% bulls. Now, 29 of the 31, the S&P rallied in the next 3 months. So it's basically saying that things are getting kind of extreme here. And then if you look back and just kind of see what the average returns were over time, you might want to pause your video player and look at this. But, 3 months later, the market, the average gain was 5.5%. 6 months later, 12.25%, and then roughly 20% a year later. So what happens is you get into these periods of extreme pessimism, and it kind of sets things up. So this is where we are, as of last Thursday. Now, the way I'm doing it is I'll take the AAI bull number minus the bear number, and the average for that over the history of the survey is 7.5%. So right now we're down to a negative 24, which is the lowest reading really since around 2016, as you can see here. So not to run out and start buying or getting super optimistic, but this is a time to really be thinking about your watch list and looking to do some buying. However, as of today, we're continuing to see the NASDAQ continue to roll over here. Basically, we had a double top in here, and then we broke down again. So, the picture's not pretty. It's actually, the NASDAQ actually broke a support level. Last week I talked about making a bottom. It's a process, not a point in time. So you can say, hey, this is the point in time, and then you pull back again. So there's going to be a lot of zigs and zags. Now here is the weekly NASDAQ where we're looking at the 35-week moving average. And unfortunately, we're starting to see that 35-week moving average turning flat to down. And we're seeing where on a weekly basis, the NASDAQ did break that support area and continues to decline. Now on the mid-cap stock, same story, rollover, basically broke through the bottom of that support. New York Composite, again, breaking through this support. Again, we came down on the 24th of January, made a low, rallied, however, failing. Now, the small caps really never did really rally. They were kind of buried and just not doing a whole lot. Now, on the large cap S&P 500, again, same story. You've got the 200-day moving average here, and we've broken below it. Again, on the weekly basis, we're breaking that support. Now, on the yield curve, I'm really torn as to what to do here, but I've decided that I think it's the 2-year versus the 10-year Treasury note. This is what I understand the Federal Reserve keeps a close eye on. So you can see here somewhat of a rollover. We invert down here, and it's definitely going in the wrong direction, which is somewhat recessionary. Now, on the aggression index, where we're comparing the NASDAQ or technology stocks to the consumer staples, which is soap, you can see here continues to decline and actually making a new low. This is not a positive sign. On our 3 economic indicators, interest rates are kind of flattening out here. This is what's interesting. Interest rates are still around 2% with all the inflation. Now on oil, we're seeing a little bit of a bounce in oil. Financial stocks along with interest rates are somewhat pulling back. New lows again too high. We had we had 337 the other day. Anything over 40 is not good. Here we have this is my trend strength. Now this is the trend strength on the NASDAQ where I'm looking at seven moving averages. You're starting to see the upper moving averages crossing over, starting to look confusing. We're down below the lowest moving average, which gives us a trend strength of 0. Now the S&P 500, same thing, trend strength was above the moving averages. However, we are seeing deterioration there. Volatility index, we're getting back up around 30. We got up to 32 the other day. The main thing to understand about the rate of change, not a rate of change, but the volatility index, is it tends to peak out around a rate of change of 50% over a 10-day period. Top 5, Starbuck Carriers. Now this is a shipping marine company. You're seeing a strong uptrend, good volume. Alcoa continues to be strong. The metals are strong. We kind of got a gap up here in an uptrend, however, somewhat failing here recently. Devon Energy, again, we're going to see a lot of energy stocks. They continue to be strong. What's happening with these independent drillers is they're not drilling. They're just maintaining their existing production. Therefore, all their revenues fall to the bottom line, mainly. And it's a real change in the drilling industry. Here is Diamondback Energy, somewhat in a flat base, however, looks okay. Marathon Oil in an uptrend. Now, this is a refiner. Now, I did want to remind everybody of our long-term thesis, which is demographics. As we can see here, the baby boomers came along, bull market. Now we're getting the millennials coming along, bull market. So the long-term picture is the same. It's just the short term, we're having some real difficulties. Call me if you have any questions. Thank you very much.